Welcome to this IFRS Keys presentation by BhalaGood. I'm Glynis Carthy, and in episode 4 of the coronavirus series, I will be taking you through provisions and contingencies. Some of the more difficult aspects of COVID-19 relate to financial hardship that has arisen, for example, related to contracts with third parties and with employees. And already we've seen some significantly difficult business decisions needing to be made, and I suspect that that's going to continue for some time in the future. In episode 4, I'll be explaining some of the key issues that you need to consider when you apply IAS 37 in this situation. And IAS 37 is a standard that deals with provisions, contingent liabilities, and contingent assets. Some of these key issues include deciding whether liability is an actual liability or whether it's just a contingency, deciding whether a contract has become onerous. So this relates to executory contracts, which we'll touch on a little later. Looking at restructurings, and then looking at reimbursements. So, for example, where there is a liability that might be reimbursed as part of an insurance claim, do we have an actual asset, or do we have a contingent asset? This slide is for information purposes. It's a decision tree that outlines whether something is a provision or whether it's a contingent liability. On the left-hand side, you'll see the requirements that need to be met before a provision can be recognized or must be recognized. And on the right-hand side, it's looking at what happens when a provision may not be recognized. How do I then decide whether it's a contingent liability? And then once I know that, what do I do with that decision? This slide looks at contingencies, so both assets and liabilities. In the slides that follow, we're going to be looking at actual provisions. So this is the only slide where we'll actually be focusing on contingencies. And on the left, you'll see we're looking at a contingent liability. So obviously, this is when we haven't recognized a provision. We need to disclose a contingent liability unless we decide that the outflow of future economic benefits is remote, in which case we then don't disclose anything. However, whether we disclose or not, we should keep reassessing. So in other words, something that was disclosed as a contingent liability could become an actual liability, and something that was not disclosed because the possibility was remote might also become a contingent liability that needs to be disclosed. On the right-hand side, we're looking at contingent assets, and with a contingent asset, you need to be careful because if it's virtually certain that it will be recovered, it is then not a contingent asset, it becomes an actual asset that we recognize. However, if it's probable but not virtually certain, then we would disclose it. And this is going to be very important when we're looking at any reimbursement from a third party for losses that have been incurred or will be incurred relating to coronavirus. We've already seen various businesses starting to restructure, and this section of IAS 37 around when a provision can be recognized or must be recognized for future restructuring is going to be quite important. It links to one of the requirements for a provision, in other words, that there must have been a past event, and it links to whether a legal obligation or a constructive obligation gives rise to that past event. So the first thing that's important to note is that a board decision on its own is not sufficient to give rise to past events. So in other words, the board cannot make a decision today and say, well, we've made the decision and that is a past event. There are two requirements that actually need to be met, and you'll see them on the left-hand side. It says that if there's a constructive obligation, for that to arise, the company must have a detailed formal plan. And secondly, the company must have raised a valid expectation in those affected by the plan. So if those requirements are not met, then you do not recognize a provision for restructuring. You would then consider whether you've got any other disclosure that might need to be made. So, for example, would you have a contingent liability? Would you just make other note disclosure that is useful to users? However, let's assume that the company has got a detailed formal plan. What IAS 37 says is that that plan must be specific as to the business that's affected, which locations are mainly going to be affected, the employees that will be terminated, where are they based, what are their functions, and how many employees. So you don't necessarily need to name each employee, but just be specific about the number that would be terminated. What expenses will be incurred in that restructuring, and then when will that plan be implemented. Then, as far as raising a valid expectation in those affected, that valid expectation is demonstrated either because the company started to implement a plan or it has actually announced the main features of that plan. If these are not met, then a company may not recognize a restructuring provision. The next aspect that we're going to be looking at is onerous contracts. And just to take a step back from onerous contracts, what IS 37 says is that when we've got an executory contract, that we do not recognize a liability for that executory contract. Now, a typical executory contract would be where, let's say, company A places an order for inventory from company B. At the time that that order is placed, that is an executory contract. Neither party has performed, or otherwise they've performed equally. And unless that executory contract is onerous, nothing is recognized in the financial statements relating to it. So this is specifically looking at items that are not financial instruments. Now, what I-37 says that is if that contract becomes onerous, in other words, the unavoidable costs of meeting the obligations under the contract exceed the economic benefits that are expected to be received under it. If that's the case, then a liability is recognized relating to that onerous contract for the unavoidable costs. And those unavoidable costs, the way that we calculate it is to say what is the least net cost of exiting from that contract. And that is one of two things. It's either the lower of the cost of fulfilling the contract, or it is any compensation or penalties that will arise from the failure to fulfill it. The lower of those two would be the amount that is recognized as the provision for that onerous contract. Just some examples of situations that could give rise to onerous contracts as a result of this pandemic. First of all, just be careful of changes to contracts or cancellations of contracts. They may well be onerous, but what we first need to consider is whether IFRS 15 or IFRS 16, so in other words, the standards that deal with revenue and leases, should be applied. And if not, then we look at IS 37 and calculate a provision for any contract that is onerous. In addition, what you might find is that there are increased costs that have been incurred. So, for example, perhaps the cost of inventory is higher because of higher or fluctuations in exchange rates. Perhaps you've had to source inventory or services from elsewhere at a higher cost. Perhaps more employees are involved simply because other employees are off sick or isolating or in quarantine. So all of those would be increased costs in fulfilling the contract. This slide deals with the May 2020 amendment that relates to onerous contracts. It specifically deals with the costs that relate directly to a contract. In other words, what costs should actually be included in that provision once you know that a contract is onerous. So just to be careful, it's not yet effective, but you'll see there that it talks about the incremental costs of fulfilling the contract, and then you also add in any other costs that are directly related to fulfilling the contract, so the allocation of those costs. And an example is given where perhaps there's property, plant, and equipment that is used to fulfill a contract, and the depreciation charge related to that property, plant, and equipment would be included in the onerous contract provision. A significant issue that arises for companies relates to reimbursements of certain provisions. So the most typical one that we're going to come across is a reimbursement for a loss of revenue if an insurance company will reimburse that. So let's just say that a company recognizes a provision and it will be reimbursed by an insurance company. So a provision for a loss of revenue that will be reimbursed by a third party, by that insurance company. What could happen is that the provision is recognized in one accounting period, but that the reimbursement is recognized in another accounting period. And the reason for that is that IAS 37 says is that that separate asset is only recognized when it's virtually certain. That's the first aspect that needs to be met. So if there's any debate that's still being had with the insurance company, no separate asset would be recognized. So once this virtually certain aspect is met, what you're really looking at, is it virtually certain that that reimbursement will be received if the company settles the obligation. So that's the focus on virtually certain. So as I've mentioned, you may well find that it's recognized, the assets and the liability are recognized in different periods. If they are recognized in the same period, what it does say in IAS 37 is that the offsetting in the income statement or the statement of comprehensive income, you can net it in the income statement. So in other words, you could show the expense from the provision, and then you would recognize the reimbursement amount against that expense. However, what you would not do is that the reimbursement amount cannot exceed that expense. However, in the balance sheet or the statement of financial position, you would not net the asset and the liability, you would recognize them separately. Thank you for listening to this presentation. If you have any questions or comments, please feel free to contact me. Until next time, stay safe.